Happy Monday, everybody. Today is October 27th, 2025, and this is your Monday market update. Last week was another busy week in the markets, one dominated by earnings from Tesla and Netflix, late week spike in yields, and growing anticipation ahead of this week's Fed rate decision. Inflation continues to ease globally, but with the U.S. economy holding steady and the government still in partial shutdown, investors are balancing optimism with caution. Now, let's get to the markets. Let's recap last week and let's preview what's ahead this week. Markets opened the week with a dose of optimism. The rally was driven by a strong individual stock showing. Apple surged after optimistic commentary on iPhone demand. At the same time, broader sentiment was aided by the easing of some geopolitical risk, specifically improved trade narrative momentum with China. The rotation toward technology and cyclicals suggested that investors were leaning into the scenario of steady growth and easing inflation. The Dow closed up 1.25%, S&P up over 1%, and the Nasdaq up 1.33%. On Tuesday, the market's tone shifted somewhat. Credit and regional bank risk popped into the spotlight. The remarks by Jamie Dimon flagged potential trouble in auto parts lending and related credit chains. He says, when you see one cockroach, we've all heard the story. That ramped up the caution, especially in financials, even as other sectors held up. The broader market was more subdued as investors balanced a strong start with this creeping concern that we just talked about. The Dow was up nearly 0.5%, S&P up 0.25%, the Nasdaq was down less than 0.25%. Midweek, we got more real signals of caution. Regional and U.S. bank shares came under pressure and signs that credit quality might be slipping. At the same time, inflation fears remained present but mixed. Some data pointed to moderation, but the shutdown of some of the government agencies means the data flow is, of course, lumpy. Weaker earnings from Netflix and Texas Instruments did weigh on the markets, with tech starting to flag. Sentiment softened. The Dow was down 0.75%, S&P down 0.5%, and the Nasdaq was down about 1%. Thursday saw the rally resume. Soft earnings and guidance from IBM and Tesla were ignored as dip buyers seemed to come in. News about more sanctions against Russian oil companies put oil into rally mode. Bond yields followed higher, and thus stocks stalled for a little bit. Later in the day, the announcement about President Trump's upcoming meeting with China gave things a boost. On top of all that, with the Federal Reserve meeting very near, investors started positioning more cautiously for the what will they say moment. We'll talk about that in just a moment. The Dow was up 1/3%, S&P up 0.5%, and the Nasdaq was up almost 1% on the day. Friday, we saw a move based on news. Intel earnings helped move the tech sector, but the big news, of course, was the CPI, delayed, and all alone is the government data. CPI came in cooler than expected, but still growing. Higher than last month, no matter to the markets and no matter to the Fed per markets. At least now they're projecting nearly a certainty of a 1/4 point rate cut this week. News flow did slow as the day went on, and the markets closed quietly but strong. The Dow up over 1%, first close over 47,000, and the S&P 500 up 0.75%. The Nasdaq was up over almost 1.25%. All three record closes. For the week, all three indices closed about 2% higher. The week ended with mixed signals. On one hand, stocks didn't collapse. They held in reasonably well given the yield and the stress backup. On the other hand, the risks that had been simmering about credit quality and central bank policy, they've moved into clearer view. Markets are acknowledging that the easy gains may be behind us, and that assumptions about continued rate cuts, stable credit, etc., are going to be tested. The takeaway: we're in a period of transition. We're not in crisis. The tent's still pitched, but the sky is showing some clouds. Staying the course, but keeping the umbrella handy is a good metaphor here. Now let's dig deeper into what to keep an eye on this week and what each item could trigger in the market. The keys for the week, of course, the first one, of course, is the Federal Reserve and the global central bank moves. The Fed is widely expected to cut by 25 basis points, taking the funds rate to about 3.75 to 4 in the U.S. But the real question is forward guidance. Will they signal more cuts, holding steady, or caution? Their tone may override the actual number. Meanwhile, the European Central Bank and the Bank of Japan also have policy decisions this week, so global liquidity and cross-asset flows do matter. As important, or in my opinion, more importantly, mega cap tech earnings and the AI narrative, with companies like Microsoft, Apple, Amazon, Meta, and Alphabet reporting this week, we're going to see how much of the bullish AI narrative is being executed. Are these firms still showing meaningful AI spend and margin expansion, or are the cracks starting to show? We'll also watch credit and credit market stress. The issues in regional banks and auto part loans are not headlines anymore, headline only anymore. Excuse me, market participants will watch whether these become isolated or wider issues. A surprise shock here could shift sentiment quickly from still good to watch out. Inflation, labor, data from the government is still non-existent. That means markets may focus more on private sector reports like consumer confidence, home sales, etc., and the commentary for some Fed officials late in the week. Any divergence from expectations will be amplified, of course. Take note, when the government does reopen, it will take some time for them to get all this data collected because they're not only not reporting right now, they're not collecting it. So what are we going to watch this week? Today, there is a conference with NVIDIA developers. And of course, anything with that company will make news. Tomorrow, we'll start to get some corporate earnings, but not the big ones yet, and the NVIDIA keynote. Wednesday is Fed decision day, and the release and, more importantly, the press conference are more important than the actual cut itself, which, again, as we said, is pretty much everyone is expecting. Then we start with earnings. Microsoft, Google, Meta, Caterpillar, Boeing. Those are all coming. And then Thursday, we're going to get more earnings: Apple, Amazon, Eli Lilly. Friday, likely more follow through from the earnings. The big oils are coming as well. How markets digest the week is going to set a tone for early November. Wrapping up, if the Fed cuts and signals further cuts, that could reignite the growth is okay, inflation is falling narrative. Of course, positive for equities, especially cyclicals and tech. But if the Fed cuts but signals we're done for now, the market may pivot to okay, but maybe no big rebound yet. Possibly more volatility, rotation into defensives. We'll see how that goes. Credit stress turning up would raise the risk premium across equities, even if not financials alone. Signal could spread. Earnings that disappoint on execution, not just sales, they could dampen the AI enthusiasm, especially in the mega caps. With data flow muted, of course, due to the shutdown, the market may react more to commentary and surprises than scheduled numbers. We're not expecting calm waters, but we're also not expecting a storm. What we're seeing is a shift in regime from everything buying on optimism to buy on good execution, managed for risks. Our plan remains anchored. We're sticking to allocations tuned for growth and awareness of credit and interest rate risk, not chasing momentum. If we see things change, we'll adjust accordingly. But so far, the interior remains sound. The key is not reacting to every swing, but staying grounded in process. Keeping an eye on our goals is still the key. This is a big week for news, but it depends on the goals as to how much that news means to you this week. Stay in touch and keep planning. Have a great week.